I'm Trey Wasser. I'm the president and CEO of ELYGF Royalties. And I'm going to jump right into our presentation here for everybody so that we have plenty of time at the end for Q&A with our host, Mark Reichman. So for jumping through here, we will be making forward-looking statements. We have to make this story really sound good. Seriously, we start with this slide, which is why invest in ELYGF Royalties, and really what is ELYGF Royalties. We are a Nevada, North American-focused, gold-focused royalty company. Of our assets right now, probably about 70% are in Nevada and 30% in Canada. And those are the only two jurisdictions that we currently have assets in. As a company and a stock, we have outperformed all royalty companies over the last 12 and 18, 24 months. Yet, as we'll show as we get into the presentation, we're still undervalued compared to our peers in the junior royalty space. We have a bit of a different approach to the royalty business. It's gotten very crowded in the last 12 months, a lot of new entrants, especially at the junior end of the spectrum. It's made royalties on producing assets very expensive in our opinion. So we are taking a different approach. We're buying royalties that maybe are 2, 3, 4 years from production, and we're finding much better value in that part of the space. We also operate a property sale business, which is a royalty generation, if you will, model. And with that, between our properties in our portfolio that are being sold, our royalty portfolio, and our available for properties that are available for sale, we have one of the largest property packages for any junior company in Nevada. Looking back at 2020, we had a great year, not just stock performance, but management execution. We increased our shareholder value by approximately 472%. That fully diluted market cap increasing from 51 million to 241 million in the 12 months. We had a very successful private placement that was oversubscribed for 17.25 million. We added research coverage, of course, early in the year with Mark Reichman at Noble, and then in the fall we added Laurentian, Jacques Wortman from Laurentian Capital in Canada. We added 6 key assets to our portfolio, doubling the size of our key asset portfolio. We purchased an additional 12 development portfolio royalties. These in our development portfolio sits below our key asset portfolio, and it's made up of properties that are at or near producing mines, or properties that are part of a larger resource that's maybe being permitted for mine construction, or in a couple of cases, just some very large resources that we think will get developed into mines. And in those, we may not have the royalty on the entire package, but on a significant part. We also added 13 properties to our sale portfolio. So we currently have 26 properties that are in the process of being purchased from third parties. This makes up most of our exploration asset portfolio and includes some very exciting projects. We'll get into that list a little bit as we go through the presentation. I'm going to talk just about the stock performance this year. We peaked at the middle of the year, right in July, and the stock's been consolidating in a downward fashion ever since. And just to point out to our existing shareholders and people who maybe got into the stock in the second half of the year and have seen this just wanted to point out that it's, you know, on a similar chart to the price of gold, although certainly a little bit weaker, having dropped below the 250-day moving average. But when you look at us compared to either the major gold royalty companies, which tend to perform in line with and predict to some degree the direction of gold price, and looking at a bottom is we're starting to see, like Franco-Nevada, the largest royalty company, very similar chart to ours as far as the maybe not the percentage drop, but the positioning around the moving averages. And Barrick Gold, same story. So we're starting to see some strength that appears to be what's a bottoming process in these stocks. Fairly good support here. We're looking at for ELY in the low $1 range. So we just like to point that out to shareholders. And you know, in the case of and we would be remiss if we didn't show the chart of one of our real true peers in the group, and that is Metalla Royalty, who started to go through early in the fall, started to do the same kind of consolidation, but made a nice upward move here. And the difference for, you know, of the mining equities and Metalla is because earlier in the year they got their New York Stock Exchange listing. Starting in November, they were added to 3 different index funds, including the GDXJ. And great move by management at Metalla for shareholders, and you know, clearly has put them on you know, on an upward trajectory here, with the buying coming a lot from those index funds additions. Still, this chart shows ELY, even with the pullback, where we stand compared to our peers for the 12-month period, including Metalla still having outperformed. And some of the key things that we did last year that really added to this. And I might point out, I'm going to be updating this slide to show that we actually had quite a few on the downside here. We still added some additional key assets and had some excellent news and things happening. It just didn't seem to, the market didn't really seem to respond to it. And again, we think that's nothing that's exclusive to ELY Gold in this environment. Now on that, we show this slide. This slide is a slide that shows the major royalty companies and the junior companies. We certainly don't show them all. This is a consensus from a company called Refinitiv, which shows the numbers based on, and the key numbers being EBITDA and the net asset value per share. This would be the consensus of all the analysts that cover the stock. So you know, you can see that you have the major companies trading as high as 2.32 in the case of Franco, and around 2 times net asset value with this coverage. These stocks, by the way, had gotten up to close to 3 times net asset value at the peak last year. Cisco being, you know, of the majors, probably the one of the more undervalued. And then looking down in the junior space, the Refinitiv doesn't, there's no analyst coverage on either Abitibi or EMX, so it's a bit tougher to cover them, but we do like to point out because we think they are, you know, size-wise right in our comparables. But then you look at Mavericks at 1.6, and Metalla with their extreme, you know, with their really strong performance stock-wise, up selling at the stock is now the highest one in the group. And again, kudos to management there with those additions. And yet here we feel like we have a very strong portfolio that compares certainly with any of our peers in the junior royalty space, and yet we're only trading at 0.9 times earnings, and we think, 0.9 times net asset value, and we think part of that is, in general, is like I said before, we are not focusing so much on current production. While we do have 4 current producing royalties, we are focused on good properties in good jurisdictions with good operators, where we will see that production start to come in 2023, 24, and 25. And we're still able to buy those type of royalties at a discount to net asset value. In some cases, 0.25 to 0.4 times net asset value. And that's very important because you will see some companies paying up. A company like Nomad did pay up for a couple of large transactions late last year. According to the Analyst, they paid close to 2 times NAV for them, and their NAV actually per share actually dropped from about 1.2 to 1.3 dollars per share down to 82. So they actually diluted. They picked up some near-term production and some current production, but they paid so much for it that they actually dropped the net asset value per share. And this is something that you really want to watch in these junior companies, is you want to see deals being done at a discount to NAV so that they are actually accretive transactions to the growth there. Just to drill down into our portfolio, like I described it, we break our assets up because we do have a combination of royalties. We have leases with royalties on them that are attached to them. And then we have properties that are being sold, which will create royalties when they're sold. So in our key assets, we have 12 now. These are assets that will all be in production by 2025. They're on some of Nevada's largest gold mines. We'll drill down on those in a minute, but we have 4 that are currently producing, both at Isabella Pearl. At Jarrett Canyon, we have 2 royalties, both an NSR and a per ton royalty on the mill there, and then our rawhide net profit interests, which start paying this year. We have 8 key additional assets there that will be in production, spread out starting next year with Marigold and through 2025 with the Fenelon Walbridge asset. We have 26 what we call development assets. Again, these are projects that are at or near producing mines and or said part of a larger resource. So in the case of Gold Resource, for example, we have the producing royalty at Isabella Pearl, but all of the expansion ground around Isabella Pearl that's currently being drilled is ground that we sold to Gold Resource and retained a royalty of 2.5%. So that's currently being explored, and that's the future production at Isabella Pearl. We also sold them 2 other projects, satellite projects, Mina Gold and County Line, and some claims at East Camp Douglas. So all projects here that have the potential to come back and be become producing royalties. The same is true at McEwen, and I won't take the time now to drill too far down on that. But on our exploration assets, we have 40 now. Again, these are a combination of properties being sold that when the sale is finalized will be royalties and royalties themselves, or leases with royalties. The leases are legacy deals. We don't typically do any leases on, currently on properties, only property sales. So, you can look at the list, very extensive, very good counterparties. VR Resources drilling on their Big Ten property. BlackRock Gold at the Tonopah West has had very great success. Contact Gold at our Green Springs property. And, again, the list quite impressive with the operators. about a dozen of the projects currently being drilled. So it's quite a list. And then we have about 20 properties in our available for sale portfolio. So I'm going to just drill down quickly on these key assets. I'm just going to highlight a couple, of the current producers, and then highlight a couple of our major properties here. Fenelon, of course, this is one of our Canadian assets. This thing is growing quite rapidly. We were expecting them, and they were talking about going into production on a small mining permit this year, and now they've just announced that they're going to extend that out, and they're going to do a new drift, which will be ready for mining and for development drilling on these rich, wide zones here in the Tabasco and Cayenne zones. Another one of our key assets that we are very excited about is Ren. Ren is the extension of the Gold Strike underground mine. 50 million ounces approximately have come out of here, about 35 million out of the open pit. All of this is controlled by the this post fault, and about 15 million ounces have come out of the underground here, and our Ren property with about 2 million ounces that have been outlined up here going back about 10 years ago. And now they are actually have drifted into this property. You can see the green line here. They've drifted in from Banshee over the Ren deposit and are now development drilling on that and doing some other exploration. We think that we're looking at production there in 2024, but we do think it could come earlier. One of our newest additions is the railroad. But one thing we like to put out about our portfolio is of these 12 key assets, 9 are at mines that are already built. They're at existing mines. So we're not waiting for infrastructure to be built at Marigold. For example, I mean, that's a mine that's been in production for many years. Our claims are coming into production in 2022 up in this section here. And Lincoln Hill, same thing, that is next to Coeur's Rochester mine. So, and not only are 9 producing mines, but 10 of them are with companies that are active operators. They're already producing. So we have very high quality assets on some of the biggest gold mines in Nevada, one of the most exciting new gold mines coming on stream in Quebec, and with some of the best operators in the business. So we've adjusted our revenue slide. This is mostly the gray is royalty revenue is driven from that previous slide. And then the blue is our sale revenue. These are the revenues coming in from property sales, where we generally do those over a 4-year contract. So it keeps a fairly consistent $2 million of revenue. And we now, with the pushback of Fenelon, we'll be adding that onto the slide here in 2025. But with their changed plan from going from small mining to a full mining permit, we think they'll do about 175 to 200,000 ounces a year at Fenelon and generate $8 to $9 million in revenue on us, which would of course be added on to the 2024 number here. So great revenue growth in the company, and again on assets that we're not looking in most cases for the mines to have to be built, and we're not dealing with junior operators that have never built mines before. We're dealing with the best operators in the business. I'm just going to, on this slide, backtrack just a little bit and just talk about the business model and how we set ourselves apart in the royalty business. One, from the business model standpoint, very important that we are both purchasing royalties and generating royalties. This, as I pointed out before, generates revenue for us on the property sales, but it also eliminates us from purchasing exploration royalties, these lottery tickets, if you will, kind of on longer term projects that are just at the exploration stage. We get paid to generate those. We don't go out and spend shareholder equity for those. We are only purchasing royalties where we can see a clear path to production in the next 3, maybe 4 years, and with good operators, and we like to see funded, permitted projects. So on the management execution side, we did 18 royalty purchases in 2020 and 16 property sales. We upgraded from on the liquidity side to the OTCQX and added that analyst coverage we talked about. And then again, the most important metric for a junior royalty company is that clear path to production. And I'm not gonna harp on it anymore here, but we are very proud of our portfolio and its prospects on the development side towards production with some of the best operators and at some of the best and biggest mines in Nevada. So go over quickly the overview for our common shares. Pretty much everything we have is in the money as far as warrants. So we have a few that are outside of it, but we generally take to just try and look at, quote everything on a fully diluted basis. You can see Eric Sprott, one of our largest shareholders. He's also one of the largest warrant holders of these outstanding, about 40 million outstanding warrants that we have. About 7.2 million in cash, a little over today, $1 million in investments of gold mining companies that we have sold properties to, a tad of debt, and so a fully diluted enterprise value about 162 million. And we do have a $6 million line of credit that is undrawn at this point for purposes. So still on a weekly basis, I mean, we think the chart is getting poised here for the next uptrend in gold prices. And we have seen a substantial increase in the volume, but on the other hand, that decreasing volume as the stock has been consolidating here for the last 6 months. Okay, I'm not going to go over too much. You guys can look at this later on the management. I can just say that we operate like a royalty company. Jerry and I are the only 2 full-time employees at the company. So we are looking at reining in our costs this year we've spent a lot of money the last couple of years in relation to our size on the promotion of the company. A lot of travel pre-COVID, to Europe, and then, a lot of these shows. We really have figured out how to do this ourselves and with people like Noble, where we are lowering our costs and maximizing the value there. And so our number one goal in 2021 is profitability. We want to be profitable in all 4 quarters. We will often hear a story or have the question of when do you expect to pay a dividend? And my answer at this point is that I believe only profitable companies should pay dividends. So that's our goal, is profitability first. The second major goal for us this year is a U.S. stock exchange listing and index inclusion. We showed you how last year how it affected Methala, and we're right about a year behind where they were in this. We're currently about ready to file our annual information form and do a prospectus for future offerings, and then the next step would be probably to look towards a New York Stock Exchange American listing, which would require a reverse split of the shares to get the stock price up. And for any of you guys who looking at it, just go look at the news from Methala, and you can see the path that they took last year. It took them just about 12 months. We'd like to add some research coverage and one more U.S. and one more Canadian bank, and then, of course, continue to execute on our business model. So that, those are our goals. We think they're very achievable. We think, we offer great value here as far as the stock. I think Mark's got about a $2, I'm Canadian, I'm talking $2 target on us, as does Jacques. I think good upside with limited downside here for us if gold can hold its bid in here and start to move higher. So with that, I'm going to turn it over to Mark for a little bit of Q&A and see if I'm not sure how much time we have left here.
Thank you, Trey. I'm Mark Reichman, the Senior Research Analyst who covers the metals and mining sector at Noble Capital Markets. I wanted to remind our viewers that if you have a question, please click on the icon in the bottom right-hand corner of your screen and type in your question. So the first question is, with respect to the key and development asset portfolio, how closely do you work with the operators and how much visibility do you have into their plans or change in plans?
Well, it depends on the asset. Actually, let me bring that slide up so we can talk about it specifically. In the case, we have great relationships with everybody. So we are working, with, of course, at the Rawhide, where we have a net profit interest. Jarrett Canyon is owned by Eric Sprott, 100%. So obviously we have a pretty good relationship there, him being our largest shareholder. And at some of the other assets, we have, I would have to say honestly, at Fenelon, we have very little input, and most of our real analysis there comes from what they're doing publicly or from other analysts. At Marigold and Wren and Hog Ranch, we actually, and now at Railroad as well, we actually own the claims there and lease the property. So we do have access and they do generate reports for us, unlike the lessor in those cases, so that we can get site visits when we want. We have access to the property. Jerry's been out to Marigold once and to Wren twice, and so it just depends there. But certainly at our at Wren and Marigold, we have very good access there, and so but there's nobody on the list of the key assets that we don't have good relationships with.
The next question is, you mentioned the prospectus. How much would you seek to raise?
I don't know that right now. We would hold off on any raising. We're going to file the AIF. We can file a prospectus with a shelf, what's called a shelf, which just leaves us open to raising. The shelf would probably be for a large amount, like I think when Metalla did their shelf, it was for $200 million. And again, if you look back, they were pretty close to where we were market cap and everything. So it's not to say you're going to raise that kind of money, but by doing the prospectus and the shelf, you can raise it quickly. It's ready. You're ready to go. So if we needed $10 million and the market we felt was right, then we could go raise $10 million. If we could also do what's called an at the money plan, where you sell into the market as you see specific buyers wanting to add positions. Kind of frustrating for us sometimes is that we have in the last couple of years we've only done one private placement, and since we've really gotten traction as a royalty company. So when we do these shows and conferences, we get people who in small institutions and that would like to add positions, but they really want to get a position started without just going into the open market. So with an at-the-money program, you can actually just sell them stock at the market, wherever the market is, without them moving the price. So a lot of flexibility there, but I would say as far as dilution, at 0.9 times NAV right now, we're not, and with about $15 million of available liquidity between our cash and the line of credit, we could make some very attractive purchases without necessarily having to go to the market. And for the most part, I think we would look at dilution not just to sit on cash at these prices, stock prices, but only if we saw an opportunity and signed paperwork to do a very attractive transaction.
Next question is, for the Gold Resource Fortitude Gold relationship, do you have any updates on their drilling at East Camp and Golden?
I don't have on East Camp Douglas. I don't know that they're doing any drilling there. I believe the only drilling that they are doing right this minute is at the Isabella Pearl on the extension property that where we have the 2.5% NSR. And I think that the Golden, I could be wrong there, but the Fortitude, and I don't believe it has started trading yet, but if somebody knows that it has, I'd be interested, because we think the Fortitude should be a pretty viable investment here. Not to give anybody investment advice, but
the second part to that question was, is there a risk of a buyout or buy down on the royalty agreements with Fortitude?
Fortitude, all of our royalties there have a 1% buy down. I believe the one at Isabella Pearl is $1 million for a 1% buy down. And I think that just off the top of my head, I believe that the Mina Gold and County Line both have a similar buy down.
Then the next question is, over what time frame will assets in the development portfolio qualify as key assets?
Well, boy, that's a great question, because it would help people to understand the development portfolio. So let's just take a quick look at it here and tell you that, for example, this last year, Gold Rock was was in the development asset portfolio, and we didn't move it up to the key assets until Fiore came out with the PEA with a mine plan and a development decision there. So that moved up. But certainly our second royalty at Isabella Pearl could move up into development as soon as they start identifying more resources. I mean, they don't have a long mine life there, so we expect them to be very aggressive in exploring that ground there. The War Eagle at Delamar, they haven't done a lot of drilling there, but they are in the permitting, and I think that that's one that could move as soon as they do a little more drilling on that high grade and maybe come up with a plan. At McEwen's, at the Gold Bar mine, we have there's on the French lease, there's resources there. They just notified us that they're putting a road through those claims past that resource to get down to the Southern Gold Bar deposit. I can't remember what they call it, but they'll be likely announcing a plan to mine the ounces, and they're doing some more drilling, we're told, this year around that French deposit. Gold Canyon is the same type of thing. As they explore that, it could start falling into the mine plan at any time. And Trenton, same with Trenton Canyon at Marigold. They're aggressively drilling that right now, and we think that'll, they'll make a mine decision on that. So a lot of these, I mean, I could spend a lot of time going through all of them, but it's, they just, most of them are there where they should become, producing royalties. I would estimate probably that 50% of the royalties in the development asset portfolio will ultimately become producing royalties.
And then the next question is, how long has Eric Sprott been an investor in ELYGF?
Eric Sprott invested in early 2019. I think his first purchase was at about 18 cents in a private placement that was just private to him. He then sold us his the 0.5% royalty on Derrick Canyon and was paid in stock there, or paid him in warrants. And then when he gave our $6 million line of credit comes from Eric, and so that he got warrants to pay that off. So he's been very active, and he also participated in our private placement in September at 80 cents. So he's been a buyer continuously every chance he gets to add to his position at ELYGF.
Well, Trey, I think that's about all the time we have. Thank you so much for joining us.
Well, thanks, Mark, and thanks everybody for tuning in or for watching the replay here. And if any other follow-up questions or anything, you can usually get my number. I'm very accessible, CEO. My email and office phone number is on every press release. So I love talking to shareholders and answering their questions directly. So again, thanks again, Mark.